There's a story I keep coming back to, and once you hear it, you're going to look at your paycheck very differently. A few years ago, a financial journalist sat down and compared two people. The first was a kindergarten teacher in Ohio, dedicated, hardworking, 22 years in the classroom. She earned $58,000 that year. The second was a private equity partner in Manhattan who made $58 million. Same country, same calendar year. The teacher paid an effective tax rate of around 22%. The partner paid closer to 8%. The teacher paid nearly 3 times more, proportionally, than someone who made 1,000 times more money. And here's what's wild. Nobody broke any laws. Not even close. That story used to make me angry. Then I spent a long time studying it. And now it makes me think differently. Not about fairness, but about strategy. Because the same mechanisms the ultra-wealthy use are not entirely out of reach. Some of them are sitting right there in the tax code, waiting for people to understand them. And most people never do. Today we're going to change that. The reason most Americans overpay taxes isn't because they're not working hard enough. It's because the tax code wasn't designed to reward labor. It was designed, layer by layer, over decades, to reward assets. And the moment you understand that one distinction, everything starts making sense. Let me explain what I mean. When you go to work and earn a salary, the government sees that income the moment it's created. Your employer withholds taxes before you ever see the money. You don't get a choice. You don't get a delay. You pay immediately, at the highest rates the tax code offers, ordinary income rates that can climb to 37% at the federal level before you add state taxes on top. But when a wealthy person's assets appreciate, when the value of their stock portfolio climbs, or their real estate goes up, or their business becomes more valuable, they own nothing, not a dollar, until they sell. This is the fundamental concept called unrealized gains, and it's the foundation of what some economists have called the buy, borrow, die strategy, arguably the most powerful wealth preservation tool the American tax code has ever produced. Here's how it works in practice, and I want you to really sit with this because it sounds almost too simple. Imagine you bought stock in a company 10 years ago. That stock has grown from $1 million to $20 million. On paper, you're worth $20 million more, but you haven't sold. You haven't triggered a taxable event, so you owe zero. Now you need cash. Maybe you want to buy a vacation home, fund a new business, or just cover your lifestyle. A normal person would sell some assets, pay capital gains tax, and use what's left. A wealthy person does something different. They go to a bank and use their $20 million in stock as collateral for a low-interest loan. The loan is not income. Loans are never taxed. So they walk away with millions in spendable cash, and their tax bill is still zero. They live off the loan. They let the assets keep growing, and eventually, when they die, something called the stepped-up basis takes effect. Their heirs inherit those assets at the current market value, and all that accumulated gain from decades of appreciation simply disappears for tax purposes. The slate is wiped clean. Buy the asset, borrow against it, die, and the tax never comes. This isn't a conspiracy theory or a loophole someone discovered in a basement. This is standard planning used by some of the wealthiest families in America. Bloomberg reported that several of the richest individuals in the country paid effective income tax rates in the low single digits for extended periods, specifically because their wealth grew through appreciation rather than income. But before you think this is only relevant if you have a $20 million stock portfolio, stay with me, because there are scaled-down versions of these principles that middle-class investors can actually use. Let's talk about capital gains rates, because most people misunderstand them completely. If you earn a salary and you're in the 22% or 24% federal tax bracket, that's what you pay on your ordinary income. But if you hold an investment for more than 1 year and then sell it, you don't pay ordinary income tax on that gain. You pay capital gains tax. And for a married couple earning under roughly $89,000 in taxable income, the long-term capital gains rate is zero. Literally 0%. This is legal. This is written directly into the tax code. And the strategy built around it is called tax gain harvesting. The opposite of what most people have heard of, which is tax loss harvesting. Instead of selling losing positions to offset gains, you strategically sell winning positions in low-income years to realize gains at the 0% rate, then buy right back in. You've just stepped up your cost basis, for free. Most people don't know this exists. Their financial advisor never mentions it. They spend years assuming that any gain will be taxed, so they avoid selling anything, which ironically can lead to poor portfolio management. But the 0% capital gains rate is one of the most underutilized tools in the entire tax code for everyday investors. Here's where the story gets even more interesting though, because avoiding taxes isn't just about what rate you pay. It's about what you own, and one asset class gets treated with remarkable, almost extraordinary, generosity by the tax code: real estate. Depreciation is one of the most powerful tax concepts in existence, and it's almost entirely invisible to people who don't own investment property. Here's the idea. The IRS allows you to deduct the theoretical wear and tear on a building over a period of 27.5 years for residential property. Every single year, you get to take that depreciation deduction against your rental income, even if the property is actually appreciating in value. So you might own a rental property that's generating $30,000 a year in rent and going up in value. But after you account for depreciation, your taxable income from that property could be near zero, or even show a loss. Meanwhile, you're collecting real cash. It gets more powerful from there. In 2017, a provision called bonus depreciation allowed real estate professionals to accelerate that depreciation dramatically, sometimes writing off the majority of a property's value in the first year. This is why some wealthy investors in real estate pay almost no taxes while building substantial portfolios. And there's a concept called a 1031 exchange, named after its section in the tax code, where you can sell one investment property, roll the proceeds into another, and defer the capital gains tax indefinitely. You keep trading up, deferring and deferring, and if you eventually pass those properties to your heirs, the stepped-up basis rule applies again. The gains vanish. The same asset, in different hands, produces radically different tax outcomes. Not because one person is cheating, but because one person understands the rules of the game. Now I want to bring this back to something that directly affects most people watching this. Retirement accounts are one of the few places where ordinary Americans have access to a version of the same tax deferral logic the wealthy use. The Roth IRA, in particular, is a remarkable vehicle. You contribute after-tax money, it grows completely tax-free, and when you retire, every dollar you withdraw is completely tax-free. If you invest $7,000 a year beginning in your late 20s and that money compounds for 30 years, you could be looking at several $100,000, or more, that the government never touches again. The backdoor Roth is an extension of this for higher earners who exceed the income limits. It's a perfectly legal two-step maneuver. Contribute to a traditional IRA, then convert it to a Roth that allows people above the income threshold to still access these tax-free growth benefits. Health savings accounts, HSAs, are another one of these hidden gems. They're the only account in the tax code that gives you a triple tax benefit. The money goes in pre-tax, it grows tax-free, and it comes out tax-free for qualified medical expenses. If you're enrolled in a high-deductible health plan and you're not maxing your HSA every year, you're leaving a significant benefit on the table. These aren't exotic strategies. They're in the tax code right now, available to millions of people who simply haven't been taught to use them. Here's the broader insight I want you to take away from everything we've covered, because this is really the thread connecting all of it. The American tax code is, at its core, a behavioral incentive system. It punishes passive labor, the trading of your time for money, and rewards capital, risk-taking, and long-term ownership. That's not a political statement. It's just a description of the structure. Salary, taxed immediately, at the highest rates, with no flexibility. Capital gains from investments held over a year, lower rates, and you choose when to realize them. Appreciation in your portfolio or real estate, not taxed at all until you sell. Borrowed money against your assets, not taxed ever. Inherited appreciated assets, the gain effectively disappears. Once you see this pattern, you stop asking, "How do I earn more?" and you start asking, "How do I own more?" Because in the eyes of the tax code, ownership is rewarded in ways that earnings never will be. The wealthy didn't invent this system. In many cases, they didn't even lobby for all of it. They simply hired people who understood it deeply, and then built their financial lives around it. The question for you isn't whether this is fair. That debate will continue long after this video. The question is whether you're going to keep operating under a set of rules you don't fully understand, or whether you're going to take the time to actually learn the game being played around you. Because every year you go without maximizing your Roth contributions, your HSA, your capital gains timing, your depreciation strategy if you own real estate, every year costs you real money. Not in a vague abstract sense, in a very concrete, compounding sense. The teacher and the private equity partner both played by the rules. One of them just had better rules explained to them. You now know many of those same rules. That's not nothing. That's actually a lot. If this video shifted how you think about taxes, wealth building, or the difference between earning and owning, I want to know. Drop a comment below and tell me, which one of these strategies were you most surprised to learn about? Or better yet, are you already using any of them? Let's build this conversation into something real. And if you want to go deeper, if you want the videos that actually break down how to implement these strategies step by step, subscribe to Noah Invests. Not because I asked you to, but because the next video might be the one that changes what you do with your money this year. The wealthy aren't waiting, neither should you.